Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. The last few days have been quite extraordinary for global banking. The headline, of course, has been the collapse of Silicon Valley Bank in the United States, this country's second biggest bank failure ever. But the flow-on effects are significant, with the impact felt on markets right around the world. Peter Deans is a former bank chief risk officer and founder of Not Without Risk Consulting. We've spoken to Peter before about banking and about governance. It's an area he knows very, very well. Peter, welcome back to Fear and Greed.
Hi, Sean. Great to be back here again.
In English, take me through what happened to Silicon Valley Bank.
Well, it's amazing, isn't it? The famous saying is a week's a long time in politics. I think a weekend is a long time in banking.
Yeah.
I was at a banking get-together a couple of weeks ago, and a run on a US bank was not one of the black swan events that was talked about. So what's actually happened? This has been looming a little bit for those who are a bit closer to the pointy end of the regional banking sector in the US, and there'd been a couple of cryptocurrency focused banks, one called Silvergate Capital, that had the wobbles for a few weeks now, and it was probably more to do with cryptocurrency and the fallout from FTX, which is probably about 8 months ago now. And then Silicon Valley Bank, which I think, as everyone knows now, was the 16th largest bank in the US with about 200 billion US in deposits, came out on Wednesday and just said that it had actually reported some losses on its asset portfolio of US treasuries of about 1.8 billion. And markets, be it debt markets or equity markets, they never like any bad news. And this sort of crystallized, I think, in a lot of investors, analysts, and deposit holders' minds concerns around the financial viability of Silicon Valley Bank. That then moved on to a little bit of a run on the bank starting on Thursday, and then it was really a gallop by Friday. And I think the figure that's been quoted was that within 24 hours, it had 42 billion US in deposits withdrawn. And you go back a few decades ago, you would have had to physically queue around the corner, take your wheelbarrow, but now it can be done at the click of a mouse. And so that really was the catalyst for a classic bank run, albeit a digital bank run.
Just without getting too technical on it, it seems the two main reasons why Silicon Valley Bank failed. The first, it's easy enough to understand. It primarily lent to a niche section of the market, the tech sector, venture capitalists getting into the tech sector. So it kind of didn't spread its risk. I get that part. When we talk about matching assets and liabilities, though, that's all about kind of not managing your balance sheet so that when money falls due, you've got enough money there. Is that right?
Oh, you asked me not to be too technical here, but it's a bit difficult when it comes to managing asset and liabilities at banks. And I've been involved in asset and liability committees at a number of Australian banks. And, you do have to stay very focused on the asset side, which is where you invest or lend the money, and then the liability side, which is where you take deposits effectively, or you might raise wholesale funds through capital markets, bonds, bond issuance, and so on. I mean, interestingly, in the case of Silicon Valley, they didn't actually have the lending problem, which is usually what brings many banks down. They were significantly cashed up, and this is part of the problem that I think's caused the collapse here, is that as at the end of 2022, they had just over 200 billion in assets, which is both sides of the balance sheet. But on the asset side, it was fundamentally cash and investments, and the investments being US government bonds, which with the rising interest rate environment had meant they're actually worth less. And on the deposit side, it was the cashed up deposits from the venture capital community, the startup community that had raised funds, and tech companies, and obviously the bank's been in operation for about 40 odd years down in San Jose. And they've obviously built a clientele in that broader ecosystem. And so, they didn't have, as I said, the usual problems of usually it's a deterioration in the assets or the portfolio that causes this. But in this case, it was actually the fact that they were so cashed up and invested in US government bonds, and those bonds were declining in value as the Fed was increasing rates. And again, interestingly, I wouldn't say 99%, but pretty well all the banks around the world will make sure they hedge that interest rate risk to make sure they don't have this problem that Silicon Valley Bank had, which is to announce losses on its bond portfolio, which if it had continued, all the equity that they had would have been pretty quickly wiped out. And I think that's why we've ended up with where we are now.
Stay with me, Peter. We'll be back in a minute. My guest this morning is Peter Deans, former bank chief risk officer and founder of Not Without Risk Consulting. It seems a long way away from Australia, what happened at Silicon Valley Bank, yet bond yields have fallen. There's been a rally in bond prices. People are now talking about the Reserve Bank not lifting interest rates by as much as we thought. Same deal with the US Federal Reserve. How's all that transferred to be so impactful on Australia?
Yeah, well, look, I think that the compare and the contrast is actually quite an interesting one between US and Australia. I mean, Australia, there is quite sound regulation and supervision of all banks, not just the large banks. So I think there's a bit of a difference here that I don't think you'd really see a run on a bank like this, because banks here are fundamentally, well managed, and they've got asset and liability committees that focus very much on this particular issue that Silicon Valley Bank has encountered. I think the contagion question, and there's been quite a bit today around the market and in the press around the fact there are some startups in Australia that are affected, but on the whole, Silicon Valley Bank is a long way away from here, and the startups in Australia, I'm sure most of them put their money in the Australian banking system, which is a good thing. I think the contagion issues probably fall more down to this unwinding of quantitative easing. And if you look at what's happened over the last 12 months, you've seen a collapse in listed tech stocks in the US and around the world. You've seen collapses of many cryptocurrency related companies and exchanges. You've seen, venture capital funding dry up. But interestingly, it's been more the investments, the willingness to invest by the venture capital firms that stopped. I was just reading this morning, Bain Capital had put out a note about a week ago saying they estimated that the venture capital industry has got 586 billion in dry powder ready to invest still. And last year they raised about 162 billion in new investment funds. So the money's there. It's just that I think the venture capital funds are a little bit risk averse, as many investors are in these volatile times. But yeah, they certainly don't have Silicon Valley Bank to put the 586 billion into anymore, because it's disappeared. But I think there's this unwinding of QE, the tightening, higher interest rates. And I think also, I'm not sure if you've covered it previously, but in the US, the Real Estate Investment Trust, or REITs, there's been a number of the very large REITs that have suspended redemptions because as interest rates have been going up, commercial property values have been going down, and some of the more savvy investors have said, well, I'm not going to wait till the losses are crystallized on a sale of a property. I'm going to actually access a buyback facility. And so there's been, again, a little bit of a rush for the door in the REIT sector, and it's just the fallout, from this higher interest rate environment and the unwinding of, which I used to say was cheap money, but basically was free money for many, many years in Europe and the US, where the cost of debt was negligible.
Perhaps we shouldn't be so surprised then that we're getting things like Silicon Valley Bank, given what you just said.
Oh, look, I think, and look, there'll be a lot of stewards' inquiries into what's actually happened with Silicon Valley Bank, because if you look at just some of the facts of the bank itself, it was about $70 billion in assets 3 years ago, $115 billion 2 years ago, and 210 or 15 million when it collapsed. I mean, a bank to double in 2 years is almost unheard of. And if you sit on the regulatory side, so the likes of APRA, the equivalent in the US, which is the OCC, and all the central bank regulators around the world, I mean, they look very closely at banks that grow too quickly. And it's very much almost like a bit of a warning sign, or you might get a speeding ticket if you're a bank which is growing too quickly, because the regulators, they see the stats which are submitted every month. They look very closely at where the growth is. I think what's probably been an issue here for regulators is that because Silicon Valley Bank hasn't fundamentally lent, I think the regulators may have been lulled into a false sense of security, because they're not taking credit risk on lending customers, be they retail consumers or business customers. But I think the regulators they'll certainly be having a bit of a post-mortem on what actually happened here. There's I think, and it's been reported a few times, the Dodd-Frank Act in 2008 was loosened under the previous Trump administration. And I think there's probably a little bit of that in the mix as well. But we might just find Silicon Valley Bank is a bit of an aberration. It's just an unusual beast that's arisen in this era of, an explosion in venture capital investment. I mean, I think that's probably that, coupled with the loose monetary policies, or perhaps that's what drove it. I think it may have created a bit of a one-off event. But having said that, if the Treasury and the US Fed, earlier this morning hadn't put in place the backstop arrangements and guaranteed the deposits of Silicon Valley Bank and others, then I think you would have probably seen a run on the smaller banks in the US.
Peter, thank you for talking to Fear and Greed.
Great to be here. Thanks, Sean.
That was Peter Deans, former Chief Risk Officer for a bunch of Australian banks and founder of Not Without Risk Consulting. This is the Fear and Greed Daily Interview. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.